If you've written off 3M as a slow-moving industrial giant, it might be time to take a second look. The company known for Post-it notes and Scotch tape is in the midst of a significant transformation, and the latest financial results suggest its strategy is starting to pay off. In this video, we're breaking down 3M's recent earnings, its strategic shifts, and what it all means for investors. We'll look at the strong growth drivers, the areas that are still lagging, and whether this current momentum is sustainable. 3M Company, originally known as the Minnesota Mining and Manufacturing Company, is a globally diversified multinational corporation renowned for its innovation and vast portfolio of products. Its core strength lies in applying science and technology to create solutions across various markets, including consumer goods, healthcare, safety and industrial, and transportation and electronics. The company is responsible for iconic inventions such as Post-it notes, Scotch tape, and Scotch Brite pads, and it holds thousands of patents. With a culture that encourages entrepreneurship and a significant investment in research and development, 3M operates in over 70 countries, serving customers worldwide with products that have become integral to both industries and daily life. Let's start with the headline numbers. For Q3 2025, 3M reported $6.5 billion in sales, a solid 3.5% increase from the same period last year. More importantly, this marks the fourth consecutive quarter of organic growth, a key indicator of underlying business health, not just price increases. But the real story is in the profitability. The company's operating margin expanded significantly, up by 130 to 170 basis points, depending on the metric. This efficiency gain flowed directly to the bottom line, with adjusted EPS coming in at $2.19, a 10% jump that beat Wall Street expectations. This strong performance gave management the confidence to raise their full-year 2025 earnings guidance.
So where is this growth coming from? It's not by accident. It's being driven by three key strategic pillars. First, a more focused portfolio. You may have heard about the spin-off of its healthcare business in 2024. This wasn't just a one-off event. It was a deliberate move to sharpen 3M's focus on its core industrial and advanced materials businesses. This allows them to concentrate resources and innovation on their most promising markets. Second, and perhaps most exciting, is a massive acceleration in innovation. 3M has laid out an ambitious plan to launch 1,000 new products between 2025 and 2027. And they're not just throwing things at the wall, they're targeting high-growth sectors like aerospace, automotive electronics, industrial automation, and safety. The proof is in the pudding. In Q3 alone, they launched 70 new products, a 70% year-over-year increase. This isn't your grandfather's 3M. This is a company aggressively chasing future growth markets. And third, operational discipline. Behind all of this is their new 3M Excellence operating model, which is driving better rigor and execution across the company. The expanding margins we just discussed are a direct result of this internal focus on efficiency. Now, it's not all smooth sailing. The report did show some softness in specific areas, notably the auto aftermarket and consumer electronics, and the broader consumer market was relatively flat. This tells us that the recovery is selective, and 3M's success is being driven by its B2B and industrial segments, not the consumer-facing ones. Finally, for income investors, the cash flow story remains strong. The company generated a robust $1.8 billion in operating cash flow and returned $900 million to shareholders through dividends and buybacks. This demonstrates a continued commitment to rewarding shareholders while funding its growth initiatives. So, how is this strategy playing out in the real world? The numbers speak for themselves. While the S&P 500 managed a respectable 9.4% gain, 3M shot up an incredible 40.2%. Look at its direct peers. Honeywell is barely treading water, and Carlyle is deep in the red. This isn't just a sector-wide boom. This is 3M's specific confidence. Now, its PE ratio of about 20.6x is slightly above the industrial sector average. The market isn't giving it a bargain bin valuation anymore. It's pricing in moderate confidence in this new growth story. As of today, 3M's dividend yield sits in the range of 1.85% to 1.91%. That's not a sky-high yield,
But the real story is in the consistency. The company pays a quarterly dividend of 73 cents per share, and here's the stat that turns heads. 3M has an uninterrupted dividend payment record for over 100 years. That's through wars, recessions, and countless market cycles. This isn't just a payout, it's a corporate legacy. So how safe is it? The single best metric for dividend safety is the payout ratio. This tells us what percentage of its earnings a company is paying out. For 3M, that number is remarkably low, sitting in a very comfortable range of 39% to 46%. What this means is that less than half of 3M's earnings are being used to fund the dividend. This is a huge sign of strength. It leaves a massive buffer for tough times, and, crucially, plenty of room for future dividend growth without straining the company's finances.
Now, let's address the elephant in the room. If you look at the past decade, 3M's dividend growth hasn't been a smooth upward line. It's been volatile, with periods of freeze and even decline, largely tied to those well-publicized legal liabilities. This created a lot of uncertainty. But here's the critical turning point that has dividend investors buzzing. In February 2025, 3M resumed raising its dividend after a period of freezing it. This is a powerful signal from management. It's a clear vote of confidence in their financial stability and their ability to manage their legal obligations. It says the worst may be behind them. Zooming out, the long-term picture for 3M's dividend is actually quite solid. Over the past 5 to 10 years, the compound annual growth rate, or CAGR, has been between 4.9% and 6.8%. That's a very respectable growth rate for a mature industrial giant. And looking forward, management is projecting strong free cash flow and operational improvements. This is the engine that will ultimately drive the dividend. With that low payout ratio we discussed, the path for gradual, sustainable dividend increases in the medium term looks well supported. 3M is a cash flow machine. In just the second quarter of 2025, it generated a hefty $1.3 billion in adjusted free cash flow. For the full year, it's guiding for a massive $5.1 to $5.5 billion in operating cash. This river of cash does three critical things. It funds a generous return to shareholders, $1.3 billion in dividends and buybacks in the first half of the year alone. It finances a huge $3.5 billion investment in R&D between 2025 and 2027, and it powers expansion into high-growth verticals like aerospace, electronics, and safety.
So they're financially healthy and spending wisely, but is the business actually growing? The answer is a confident yes. After a slow 2024, 3M expects organic sales to grow 2 to 3% this year. More impressively, they recently raised their earnings guidance. They now expect to earn between $7.95 and $8.05 per share, up from their previous forecast. This leads us to the most exciting part, the profitability boom. 3M isn't just growing, it's growing more profitably. Its adjusted operating margin has jumped nearly 2 percentage points to almost 25%. This isn't by accident. It's the result of ruthless cost control, restructuring, and operational efficiency. The proof? Their return on invested capital, or ROIC, is now between 11 and 13%, comfortably above their cost of capital. This means every dollar they invest is creating genuine shareholder value. And they're turbocharging this with innovation. What is 3M actually worth right now? The current metrics tell a mixed story. 3M's price-to-earnings ratio is around 20.6 times. That's slightly below its direct peers, but higher than the broader industrial sector. Its enterprise value to revenue and EBITDA multiples also sit in a similar, moderate zone. In simple terms, the market isn't giving it a bargain basement price, but it's not pricing it as a high-flying growth stock either. It's essentially priced for steady, stable performance. But when we look at more complex models like discounted cash flow, or DCF, the picture gets interesting. Some DCF models suggest a fair value could be as low as $130 per share, which would mean the current price near $167 is overvalued by about 22%. However, Other approaches, like the dividend discount model, which values a stock based on its future dividend payouts, suggest the current price is actually quite fair. The bottom line? From a pure numbers perspective, 3M looks fairly valued to slightly overvalued, with a lot depending on which model you trust most. The company is facing enormous liabilities. We're talking about $16 billion and counting, from PFAS, forever chemical contamination, and lawsuits over respiratory protection for coal miners. These have directly hurt their GAAP earnings and created significant volatility. Beyond the courtrooms, 3M faces intense competition across all its product lines, pressure from regulators, and the broader risks of a global economic slowdown. So what is 3M doing about it? The company isn't standing still. They're undergoing a major operational restructuring, adjusting their product portfolio and strategically pivoting towards high-growth innovation sectors, with a goal of launching 1,000 new products by 2027. They're fighting back, but the legal risks remain a dark cloud. So, with this mix of fair valuation and high risk, who is 3M actually for? Let's break it down by investor profile. For the dividend investor, if you're here for reliable income, 3M still deserves a close look. It boasts a strong history of payments, a current yield around 1.9%, and most importantly, a very sustainable payout ratio of about 40%. This is supported by robust cash flow, making the dividend look safe for the foreseeable future. For the growth investor, if you're seeking explosive growth, 3M might not be your first pick. Its growth is more measured. However, there is a case to be made here based on its innovation drive and plans for margin expansion. It's a turnaround growth story, not a tech-style moonshot. For the value investor, if you're looking for a margin of safety, 3M is a tricky case. It's not a clear bargain. But for a value investor who believes in the durability of the brand and its steady cash flows, and who thinks the company can manage its legal liabilities, there could be moderate upside potential once the headwinds subside.
As of October 2025, the overall analyst consensus for 3M is a moderate buy. But what does that really mean? Let's look at the numbers. Out of 19 analysts covering the stock, 9 are recommending buy, 3 are saying hold, and several others are advising caution or even a sell. This mix tells a clear story. There's growing confidence, but it's tempered by a strong awareness of the risks. It's not a unanimous all-in signal, but a cautious optimism. We've seen a wave of price target upgrades from major firms. UBS raised its target to $190. Wells Fargo lifted theirs to $183 with an overweight rating. And in a significant move, Morgan Stanley upgraded 3M from underweight to equal weight and raised its price target to $160, pointing to clear signs of a management-led turnaround and improving organic growth. On the cautious side, we have firms like RBC Capital, which raised its price target, but only to $130 while maintaining an underperform rating. This highlights a real divergence of opinion on what 3M is truly worth. In summary, the analyst community is leaning moderately positive. They're starting to view 3M as a fundamentally sound company with genuinely improving prospects. The management team appears to be steering the ship in the right direction. So what's your take? Is 3M's turnaround story enough to outweigh the litigation risks? Let us know in the comments below. Don't forget to like and subscribe for more deep dives into the companies shaping the market. Thanks for watching.